Picture this. It's March 8th, 2023. You're a startup founder with millions sitting in your business account at Silicon Valley Bank. You go to bed thinking your money is safe. You wake up the next morning and your bank, the 16th largest in America, no longer exists. In just 24 hours, Silicon Valley Bank went from business as usual to complete collapse, sparking the biggest banking panic since 2008. But here's what makes this story absolutely wild. This wasn't caused by risky loans or fraud. This was a textbook example of how modern banking vulnerabilities can destroy even the most successful institutions in record time. Today, we're diving deep into the numbers, the mistakes, and the domino effect that nearly broke the entire banking system. By the end of this video, you'll understand exactly how a bank with $209 billion in assets vanished overnight and why this collapse sent shockwaves through Wall Street that we're still feeling today. Before we get to the dramatic collapse, let's understand what Silicon Valley Bank actually was, because this wasn't your typical neighborhood bank. Founded in 1983, SVB became the go-to bank for tech startups, venture capital firms, and the entire Silicon Valley ecosystem. While your local bank might have customers from all walks of life, SVB had an incredibly concentrated customer base. We're talking about 44% of all U.S. venture-backed companies banking with them. Here's where the numbers get interesting. By the end of 2022, SVB had grown to massive proportions: $209 billion in total assets, $175 billion in deposits, ranked as the 16th largest bank in the United States. But here's the kicker, and this detail is crucial to understanding the collapse. A staggering 94% of their deposits exceeded the FDIC insurance limit of $250,000. Think about that for a second. While the average American has their deposits fully insured, SVB's customers were playing with house money above that $250,000 mark. The bank's business model was beautifully simple during the good times. Tech companies and VCs would deposit their cash, and SVB would lend it back to other startups or invest it in safe government securities. During the tech boom from 2019 to 2021, deposits flooded in faster than they could make loans, so they parked massive amounts in long-term government bonds. This seemed like the safest possible investment. Government bonds are literally backed by the full faith and credit of the United States. What could go wrong? Well, as it turns out, everything could go wrong, and it all started with something called interest rate risk, a concept that would prove fatal for SVB. Let me break this down in simple terms. When you buy a long-term bond, you're essentially lending money to the government for a fixed interest rate. In 2020 and 2021, interest rates were near zero, so SVB bought billions of dollars worth of bonds paying around 1.5% to 2%. But then the Federal Reserve started raising interest rates aggressively to fight inflation. By early 2023, new government bonds were paying over 4%. Suddenly, SVB's bonds paying 1.5% looked terrible in comparison. Here's the math that killed SVB. If you're holding a bond paying 1.5% and similar bonds are now paying 4%, your bond is worth significantly less if you need to sell it. This is called an unrealized loss, and by the end of 2022, SVB was sitting on $15 billion in unrealized losses on their securities portfolio. But unrealized losses only become a problem if you need to actually sell the bonds. And that's where SVB's concentrated customer base became a fatal weakness. Starting in 2022, the tech industry hit a rough patch. Interest rates rising meant venture funding dried up. Startups started burning through their cash reserves instead of raising new rounds. Companies that had deposited millions during the boom years were now withdrawing money to fund operations. SVB's deposits started hemorrhaging. In 2022 alone, they lost $13.3 billion in deposits. But the real crisis was just beginning. Now we get to March 8th, 2023, the day that started SVB's death spiral. Facing continued deposit outflows, SVB made a decision that would seal their fate. They announced they had sold $21 billion of their securities portfolio, crystallizing a loss of $1.8 billion. But that wasn't the worst part. They also announced plans to raise $2.25 billion in new capital to shore up their balance sheet. In banking, announcing you need to raise capital is like blood in the water for sharks. It signals weakness. But SVB's management made an even bigger mistake. They telegraphed this announcement to their customers first, many of whom were financially sophisticated venture capitalists. Here's where modern technology turned a manageable problem into an existential crisis. Word spread like wildfire through Silicon Valley's tight-knit network, WhatsApp groups, Slack channels, Twitter. Within hours, everyone was talking about SVB's problems. Peter Thiel's Founders Fund advised their portfolio companies to withdraw money from SVB. Other VCs followed suit. But remember, these weren't regular customers pulling out a few $1,000s. These were companies with millions or tens of millions on deposit. The numbers from March 9th are staggering. $42 billion in withdrawal requests in a single day. That's 24% of the bank's total deposits. By comparison, during the 2008 financial crisis, Washington Mutual, the largest bank failure in U.S. history at the time, had outflows of just $16.7 billion over several days. By the end of March 9th, SVB had a negative cash balance of $958 million. They literally didn't have enough money to meet withdrawal requests. Before we dive into what happened next and the broader implications, I want to ask you something. If you're finding this breakdown of the SVB collapse valuable, please hit that like button. It really helps the algorithm understand that detailed financial analysis like this is what you want to see. And if you haven't subscribed yet, make sure to do that now because we break down complex economic events like this every week, giving you the numbers and insights you need to understand what's really happening in the world of finance. March 10, 2023, started with SVB desperately trying to find a buyer or raise capital, but by this point the situation was hopeless. California banking regulators shut down the bank and handed control to the FDIC at 10:05 a.m. Pacific Time. In less than 48 hours, the 16th largest bank in America had completely collapsed. But the story doesn't end there, because the failure of SVB triggered a cascade of problems across the banking system. First, there was Signature Bank in New York, which failed just 2 days later on March 12th. While smaller than SVB at $110 billion in assets, Signature's failure showed this wasn't just a Silicon Valley problem. They had their own concentration risk serving the cryptocurrency industry. Then came the fear contagion. Regional banks across the country saw their stock prices plummet as investors wondered, who's next? First Republic Bank, despite being fundamentally different from SVB, saw massive deposit outflows simply because they were also a regional bank serving wealthy clients. The numbers tell the story of the panic. Regional bank stocks fell 25% in the week following SVB's collapse. First Republic lost $100 billion in deposits in the first quarter of 2023. Credit Suisse, already struggling, saw its situation deteriorate rapidly amid the global banking fears. Recognizing the systemic threat, regulators took unprecedented action. On March 12th, they announced that all deposits at SVB and Signature would be made whole, even those exceeding the $250,000 FDIC limit. This wasn't technically a bailout of the banks. Shareholders and bondholders were wiped out, but it was a bailout of the depositors. The price tag was enormous. The FDIC estimated that protecting uninsured depositors would cost their insurance fund $20 billion just for SVB alone. The SVB collapse revealed several critical vulnerabilities in our modern banking system that go far beyond one poorly managed bank. First is the speed of modern bank runs. Historically, bank runs took days or weeks to unfold. Customers had to physically go to branches to withdraw money. Today, with mobile banking and social media, a bank can face fatal deposit outflows in hours. SVB experienced what experts now call the first digital bank run. Second is the concentration risk problem. SVB wasn't just concentrated by geography. They were concentrated by industry, customer type, and even social networks. When your customers all talk to each other and move in herds, a crisis can spiral out of control instantly. Third is the interest rate risk that many banks still face. The Federal Reserve raised rates from near 0% to over 5% in less than 2 years. Any bank that loaded up on long-term, low-yielding assets during the pandemic is sitting on significant unrealized losses. Here are the numbers that should concern everyone. The FDIC estimates that U.S. banks are sitting on $620 billion in unrealized losses as of late 2023. 63% of deposits at regional banks exceed the FDIC insurance limit. Commercial real estate loans, another area of concern, total $2.7 trillion across the banking system. The collapse also highlighted the too big to fail problem in a new way. SVB wasn't too big to fail because of its size, but because of who banked there. With nearly half of all venture-backed companies as customers, allowing uninsured deposits to disappear could have crippled the entire startup ecosystem. So, what can we learn from the SVB debacle? Several key lessons emerge from this financial disaster. For banks, the lesson is clear. Concentration is dangerous. Whether it's by industry, geography, or customer type, putting all your eggs in one basket creates existential risk. SVB's management failed to diversify their deposit base and failed to manage interest rate risk properly. For depositors, especially businesses, the lesson is about FDIC limits and diversification. Keeping $50 million at one bank might seem convenient, but it's not safe. Smart money managers are now spreading deposits across multiple institutions to stay within FDIC limits. For regulators, SVB exposed how outdated their tools are for the digital age. Bank examiners were still using frameworks designed for the era of physical branch visits, not viral social media panics. The regulatory response has been swift. New proposals requiring banks to hold more capital against interest rate risk, enhanced liquidity requirements for regional banks, stress testing that includes rapid deposit outflow scenarios. But perhaps the most important lesson is about moral hazard. By protecting all depositors, regulators prevented a systemic crisis, but created a precedent. If the government will step in to protect uninsured deposits at failed banks, what incentive do depositors have to monitor their bank's risk-taking? The collapse of Silicon Valley Bank wasn't just a single bank failure, it was a wake-up call about the vulnerabilities in our modern financial system. In an era of digital banking, social media, and concentrated business networks, traditional risk management approaches simply aren't sufficient. The numbers tell the whole story. $42 billion in withdrawals in one day, $20 billion in taxpayer costs, and $620 billion in unrealized losses still sitting on bank balance sheets across the country. This wasn't an isolated incident. It was a preview of how quickly modern banks can collapse when faced with the perfect storm of rising interest rates, concentrated customers, and digital panic. For investors and business owners, the SVB collapse is a reminder that even the most successful institutions can disappear overnight. Diversification isn't just important for your investment portfolio. It's crucial for where you park your cash. As we move forward, the banking industry will need to adapt to this new reality where a bank run can happen at the speed of a tweet and where interest rate changes can vaporize institutions that seemed rock solid just months before. The Silicon Valley Bank collapse of 2023 will be studied for decades as a textbook example of how traditional banking risks can be amplified by modern technology and concentrated business relationships. The question isn't whether we'll see another SVB, it's whether the industry has learned enough from this disaster to prevent the next one from taking down the entire system. What do you think? Are regional banks still at risk, or have the lessons from SVB made the system safer? Let me know in the comments below, and don't forget to subscribe for more deep dives into the events that shape our financial world.